You assume banks are fragile, that they live and die by market cycles, that when things collapse, everyone bleeds equally. But there's one bank that seems to walk through every financial fire untouched. Crashes come, recessions hit, governments panic. And somehow it always emerges bigger, calmer, stronger. You don't bank with it by accident. You don't hear its name in headlines by coincidence. And when the world starts to shake, your money quietly moves closer to it. Not because it's the smartest, not because it's the richest, but because the system itself leans on it to stay standing. Most people think banks compete with each other. What they don't see is that some banks stop competing and start becoming structural. That's the uncomfortable truth behind JP Morgan. A bank so embedded in global finance that its survival becomes everyone else's priority. And once you understand why that happened, you'll realize your money has never been as independent as you thought. If one bank must survive, who really carries the risk when everything breaks? Most people believe banks exist to serve customers, to hold deposits, issue loans, and facilitate growth. That they succeed when economies succeed and suffer when economies fail. That belief feels reasonable. It's also dangerously incomplete, because JP Morgan isn't just a bank anymore. It's a pillar holding up payment systems, government financing, corporate liquidity, and crisis response mechanisms all at once. When markets freeze, JP Morgan doesn't wait for instructions. It becomes the instruction. When confidence evaporates, its balance sheet becomes a substitute for trust. This didn't happen overnight. And it didn't happen by accident. Every major financial crisis over the last century quietly reinforced the same lesson. Some institutions are allowed to fail, and some are not. JP Morgan learned how to position itself in that second category. Not through reckless risk-taking, but through scale, connections, and strategic usefulness. So when you fear financial collapse, when headlines talk about banks failing, markets breaking, and governments scrambling, JP Morgan doesn't look like a risk. It looks like an anchor. And anchors feel safe when the storm hits, even if you don't fully understand what they're attached to. The uncomfortable question isn't whether JP Morgan is powerful. It's whether its power exists because the system can't function without it anymore. But how did one bank quietly move from competitor to financial infrastructure itself? Most people believe JP Morgan wins because it's simply better managed. Smarter executives, better risk models, superior discipline. That explanation feels comforting, but it's only part of the truth. The deeper reality is this. JP Morgan didn't just grow bigger than its competitors. It grew more necessary than them. While other banks focused on products, JP Morgan focused on position. It placed itself at the center of government financing, corporate cash flow, and global settlement systems. Not flashy, not loud, just indispensable. When the US government needs to move trillions in debt, JP Morgan is there. When corporations need liquidity during panic, JP Morgan is there. When regulators need a stabilizer during chaos, JP Morgan is already in the room. That changes how risk works. For most banks, risk is personal. If they fail, they disappear. For JP Morgan, risk becomes shared. Because once a bank reaches a certain level of embeddedness, its failure doesn't just hurt shareholders. It threatens payrolls, pensions, markets, and political credibility. That's the belief most people get wrong. They assume markets punish everyone equally. In reality, systems protect what they rely on most. JP Morgan didn't escape risk. It redistributed it outward into the system itself. And once that happens, losing is no longer an option anyone can afford. But what happens when the system starts protecting one bank over everyone else? Now place yourself inside a crisis. Markets are falling. Banks are failing. News anchors are using words like contagion and systemic risk. Your first instinct isn't to maximize returns. It's to survive. And in moments like that, logic gives way to gravity. Money doesn't flow to the smartest idea. It flows to what feels safest. That's where JP Morgan's power becomes psychological. Investors trust it because governments trust it. Governments trust it because markets trust it. Markets trust it because history says it survives. This loop feeds itself. Every crisis strengthens the same perception. JP Morgan is the place money hides when fear takes over. That perception becomes reality. Deposits rise during chaos. Influence deepens during uncertainty, and competitors quietly weaken. This isn't about conspiracy. It's about human behavior under pressure. When collapse feels possible, people don't ask who deserves power. They ask who can prevent disaster. And JP Morgan has positioned itself as that answer. But here's the unsettling part. The safer JP Morgan feels, the more dependent the system becomes. And the more dependent the system becomes, the harder it is to ever let it fail. That's not stability, that's a trade. So where is the invisible line between stability and silent dependency? Here's the hidden rule most people never hear out loud. Modern finance isn't built to be fair. It's built to be stable enough. And stability has a hierarchy. During crises, governments don't ask which bank behaved best. They ask which failure would cause the most damage right now. That single question quietly decides who gets protected. JP Morgan understood this earlier than most. Instead of chasing maximum profit at the edges, it invested in being unavoidable. It became the primary dealer for government debt, a critical counterparty for corporations, a trusted executor during emergency takeovers and rescues. So when the system is under stress, JP Morgan doesn't wait for help. It becomes the mechanism through which help flows. That flips the power dynamic. Regulators stop seeing the bank as just another institution. They start seeing it as infrastructure. And infrastructure isn't allowed to fail on schedule. This is why JP Morgan doesn't just survive crises. Crises reinforce its position. Every rescue it facilitates deepens political trust. Every emergency role expands its reach. Every collapse elsewhere quietly increases its relative power. The system doesn't protect JP Morgan because it loves the bank. It protects JP Morgan because the alternative feels worse. And once an institution reaches that level, its losses become everyone's problem, while its survival becomes everyone's priority. That's the real reason the bank never seems to lose. Not invincibility, interdependence. But what does this kind of protection cost the rest of the financial system? This is where the story shifts from JP Morgan to you. Most people think safety comes from avoiding risk, from staying small, from keeping things simple. But JP Morgan teaches a different lesson. Real protection doesn't come from being cautious. It comes from being essential. The bank didn't eliminate risk. It structured itself so others absorb it alongside them. That's not morality. That's system design. For individuals, the lesson isn't to admire banks. It's to understand positioning. When you are replaceable, the system lets you fail quietly. When you are critical, the system works around you. That principle shows up everywhere. In careers, in businesses, in networks. The closer you are to the core functions others depend on, the more resilient you become to shocks. This doesn't mean chasing power recklessly. It means understanding what makes you necessary. JP Morgan didn't win by being the fastest or the boldest. It won by becoming the default. And defaults are hard to remove. Once you see that pattern, fear loses some of its grip, because collapse stops feeling random. You begin to see where safety actually concentrates. Not at the edges, at the center. So if power concentrates at the center, where does that leave the future of everyone else? Today, JP Morgan's position is no longer subtle. It sits at the intersection of markets, governments, and global capital flows. Not as a loud ruler, but as a quiet constant. When new regulations appear, JP Morgan helps shape how they function in practice. When banks fail, JP Morgan is often asked to absorb the shock. When uncertainty rises, capital doesn't scatter. It consolidates. This is the modern reality of financial power. It doesn't announce itself. It stabilizes itself. And that stability sends a message to the world. This institution is part of the operating system. For everyday people, this has two effects. First, it reduces chaos. Your payments clear. Your deposits feel safe. Markets keep moving. Second, it concentrates influence. Because when survival becomes guaranteed for a few, competition becomes asymmetrical for everyone else. Smaller banks must innovate or disappear. New players must navigate around entrenched giants. And the system slowly hardens around what already exists. JP Morgan didn't just adapt to modern finance, it helped define its limits. That's why it still stands when cycles turn, and why its shadow stretches far beyond banking headlines. If stability protects the center, who absorbs the instability at the edges? This story isn't about whether JP Morgan is good or bad. It's about understanding how systems really work. Power doesn't always look aggressive. Sometimes it looks reliable. Sometimes it feels comforting. But comfort has a structure. And once you see it, you stop being surprised by outcomes. At RN Wealth, that's the real goal. Not to scare you, but to help you see clearly. Because clarity reduces fear, and understanding systems helps you move through them with intention. If this episode helped you understand where stability actually lives, you're already thinking differently than most people. Stay curious, stay observant, and remember, every empire reveals something about you too. Once you see the system clearly, will you stay on the edge or move closer to the center?